Looking to give your portfolio returns a little boost? Small cap stocks might be the answer. These are companies valued between $300 million and $2 billion. They can trade on any exchange, but you'll mostly see them on the NASDAQ and over the counter because they have looser listing requirements. And while some might trade for less than $1, these aren't penny stocks we're dealing with here. So, how do small caps stack up against the biggest companies on the market?
This chart shows the performance of the S&P 500 in gray and the Russell 2000 in yellow from 1987 to 2024.
The S&P 500 index tracks the performance of the 500 largest companies in the United States, and the Russell 2000 index tracks the performance of 2,000 small cap stocks in the United States. As you can see here, one of the longest sustained bull markets occurred from 2009 to late 2018. During this time, the S&P 500 grew by 316%, and the Russell 2000 grew by 361%. A more recent bull market occurred after the COVID-19 outbreak. From March 2020 to July 2020, you can see the S&P 500 grew by 35%, and the Russell 2000 grew by 51%. Both these periods saw near zero interest rates, which made it easier for companies to borrow money to finance growth. And because small caps have a lower share price than these large cap companies, it can be easier for them to grow. Think of it like blowing up a balloon. At first, the balloon seems easy to blow up and it can double in size quickly. But as the balloon gets bigger, it gets harder to blow up and takes even more breaths to double in size. And just like a balloon, small caps can be fragile and sensitive to market and economic conditions. If we look at the last 3 major market downturns, the Russell 2000 has lost more than the S&P 500. In fact, during the dot-com bubble crash, the Russell 2000 was down around 12%, while the S&P 500 fell roughly 11%. The subprime crash in 2008 saw the Russell 2000 fall by almost 60%, while the S&P 500 lost 55%. And most recently, during the COVID pandemic of 2020, the Russell 2000 dropped around 38%, while the S&P 500 fell only 22%. Now, that's a lot to think about, but historical performance isn't the only thing to consider when deciding whether to buy small cap stocks. For starters, they can be an attractive investment because the sheer number of them can make it easier to diversify your portfolio across multiple sectors and industries. And their low price can make them ineligible for many large institutional investors, even though there are small cap focused ETFs and mutual funds. This means that investors like you and I can get invested in a company before institutional investors raise the share price. The downside is this can also lead to less analyst coverage, so there's often less information available about the company. And their low price and volume can lead to large price swings. Not to mention that small caps are more prone to bankruptcy compared to large caps. So, if an investor is willing to take on some risk, they could adjust a small cap portion of their portfolio to match market conditions, which could look like increasing it during bull markets, especially when interest rates are low, and reducing it during market crashes. To find your next small cap opportunity, head over to WebBroker and check out the screener tool. You can use it to search for small cap stocks, ETFs, and mutual funds. Plus, use dozens of additional criteria to customize your list. And for more tips, watch our course How to Research Investment Ideas in WebBroker.